Good morning, everybody. This is part two, the hearing on California homeowners insurance market with the Little Hoover Commission, Thursday, April 25th, 2024. I'm Pedro Nava. I'm chair of the Little Hoover Commission. Thank you all for joining us today. There are other commissioners who are here with us virtually. Vice Chair Anthony Cannella, Commissioner David Beyer, Commissioner Gil Garcetti. And my understanding is that Commissioner Yana Sidley will be joining us, and we expect to hear from Commissioner Dion Aroner. Two other of our commissioners had conflicts with today's meeting time. Also with us today are the commission staff, Executive Director Ethan Rarick, Deputy Executive Director Tamar Foster, Analyst Ashley Hurley, Allie Powell, and Shara McAllister, along with project managers Crystal Beckham and Daniel Harris McCoy. In the interest of time, I'm going to skip the usual housekeeping items and turn to the subject at hand. We will provide instructions on the public comment session later in the hearing. Today is the second in a series of hearings examining California's homeowners insurance market and exploring potential reforms that may be needed. Our first hearing helped frame the current state of the home insurance market in California. Today, we'll further this conversation and begin to analyze the impact of climate change on the insurance market. We will hear testimony from representatives from the California Fair Plan and Surplus Line Association of California, as well as a former director of the California Office of Emergency Services and an urban planner specializing in disaster recovery and catastrophe risk management. I want to thank Vice Chair Cannella and Commissioner Sidley for serving on the subcommittee for this topic and for their leadership. Now, let's turn to Senior Research Analyst Ashley Hurley to introduce our first witness.
Thank you, Chair Nava, and good morning, Commissioners. Our first witness this morning is Victoria Roach. Ms. Roach has served as the president of the California Fair Plan since 2022. The Fair Plan was established to help California homeowners enable to find insurance in the traditional marketplace. Previously, she served as the plan's Senior Vice President of Business Operations and Director of Underwriting and as Director of Product Management at Farmers Insurance. When you're ready, you may begin your testimony.
There we go. Thank you. My name is Victoria Roach, and I am the... We good? Okay, thanks.
I'm sorry, we're good now, Ms. Roach. We couldn't see you for a moment, but now we can. Please go ahead.
Oh, sometimes it's better if you can't see me. It's all right. I'm Victoria Roach. I am the president of the California Fair Plan, and thank you for having me here this morning to talk about the homeowners market in the state of California. I'll give you a little bit of background and then we can open up for questions and discussions. I did send some background information. I'm not sure if everybody had a chance to look at it, but for those people who didn't, and to set the stage for the audience and provide some context, I'll just give a few opening remarks. As a reminder, the California Fair Plan is not a state agency and we are not state funded. We are not funded by taxpayers. We are funded primarily by the policies we sell. We operate as a not-for-profit and we are not subject to Prop 103. We do provide insurance to consumers across the state, regardless of where their home resides, even if they're in high wildfire areas. And we are set up as the insurer of last resort, which means that we are committed to our mission and our purpose as defined by the legislature to offer basic property coverage for Californians who are unable to find insurance in the voluntary or surplus lines markets. With that, today, based on what's going on in the market, we continue to grow at unprecedented rates. So our the number of consumers we insure in the state has more than doubled since 2019. If you look across the state, We cover about $320 billion of exposure. We write in primarily high-risk areas, although today, with the crisis we are in the insurance market, we are writing a considerable amount of risk in low or no wildfire areas. We are committed to working with the Department of Insurance on their sustainable insurance strategy. We are committed to working with the legislature, the governor's office, and other stakeholders to meet the goals of the sustainable insurance strategy, which for us means depopulation. So today, with the number of policies we're writing, we are one of the largest writers of residential property insurance in the state of California. For us specifically, within the sustainable insurance strategy, the California FAIR Plan needs to have adequate rates, which includes the net cost of reinsurance and catastrophe modeling. Once the market is set to re-engage, then we will work to depopulate and help as much as we can provide a platform for moving in customers from the California FAIR Plan back into the voluntary market. With that, Mr. Chair, I thank you, and I'm open to questions or discussions.
I want to thank you and give my fellow commissioners the opportunity to raise their hands if should they choose. But can you tell us? Well, never mind. I'm going to turn to I see my vice chair Cannella has his hand up. I always prefer to hear from commissioners before I speak. So please go ahead, Commissioner or Vice Chair Cannella, followed by David Byer.
Thank you, sir. So you mentioned how the FAIR Plan is funded with selling policies, and I think I understand that. But what happens if the FAIR Plan can't pay out on the policy? So if something happens and there's just not sufficient funds to pay off all the demands, what happens?
So in the event that we have a catastrophe and the claims that are coming through, we don't have the capital to fund those claims, we will assess the market. So based on market share, 2 years in arrears, we will send a bill to each insurance company to provide money to the FAIR Plan to cover our losses and or operating expenses.
Okay, so even though they're not making any money selling policies, they're still on the hook to cover the cost of the shortfall that you can't pay out. Is that correct?
That's correct.
Okay, so if it just seems like a house of cards a little bit, if the insurance companies claim, and I think the data proves it right, that they can't operate and they're not writing new policies yet, they're on the hook if something happens. It's I think this may make us feel good that there's this FAIR Plan, but I don't know that ultimately it's going to provide the resources necessary if something happens. So thank you.
Thank you. Let's go to Commissioner Byer.
Thank you, Mr. Chairman. I have 3 brief questions. First, you indicated that the FAIR Plan insures people in fire-prone areas. My question relates to moral hazard. That is, don't people engage in riskier behavior if they think they're going to get bailed out by the government or by an insurance scheme? And wouldn't we be better off if there were limitations on insurance in high-risk areas?
So in the world of insurance, you're right, moral hazard is an issue and one we would consider when writing. As an insurer of last resort, we have very limited underwriting guidelines. So if a house is insurable, we're going to insure it regardless of where they're located, which creates an issue because then we have obviously a concentration of risk in the high risk areas, right? We don't have any way to control that exposure where a company in the voluntary market or surplus lines carrier has a little more control over where they're writing their business and what business they're writing. by design, that's how we're set up.
No,
Right.
I understand. I understand. I'm not being critical of.
No, I understand, yeah.
So my second question is, given the risk that's being assumed, which then, as you explained, circles into the admitted plans
Mhm.
without their control, they're essentially having an unfunded liability, which then devolves to the ratepayers in an unaccountable way. So the more people who build and insure in high wildfire areas, the greater the risk to the FAIR plans and the greater the risks to the ratepayers in areas that are not exposed to wildfire. That seems perverse because the rates for people who behave well and locate themselves and harden their houses will go up based on the moral hazard that we're setting up under this scheme.
So I would agree with what you're saying. And I think the legislature in the 90s agreed when we did our first assessment. So after the Northridge quake and some subsequent fires, the FAIR plan assessed the industry. Following that, the legislature came back and said, kind of what you're saying, right? This doesn't make any sense. The insurers are saying, we don't have a rate and we can't write in these risks. We can't write these risks. Now we send them to the FAIR plan, but when there's losses, the losses come back to us and we've gotten no premium for those risks. So the legislature said that doesn't really work because somebody has to pay for that. And in the end, it'll become an indirect tax on the rest of the consumers in the state of California. Right? Everybody will be paying a part of that to subsidize what's going on with the FAIR plan, which makes no sense. So they passed legislation to say, at the very least, the California FAIR plan needs to have actuarially sound rates. They have to bring in enough money to cover the potential losses that they're going to incur in the event of a catastrophe. So that means basically we take all of our expenses and our loss exposure and we build that into our rates and we charge the right rate. Right now we're in discussions with the Department of Insurance about that because while we are permitted to and believe that it's a financially responsible decision to buy reinsurance so that as soon as we run out of money, it's not only that we're not only going to the market, but we've also got this other insurance over here that's going to help us pay our losses. It's one of our biggest expenses, as you can imagine, to buy insurance for an insurance company, especially in wildfire areas. The Department of Insurance has said, well, we're not sure you need to buy all that reinsurance and we're not sure about reinsurance rates. So we don't want you passing that along to your policyholders. So you can't include that in your rate making. So what happens then is we're already not charging enough rate. And if we're not charging enough rate, it just exasperates that risk of assessment to the voluntary market.
Thank you. That's very comprehensive. Second question is, would we as Californians be better off if the FAIR plan was a government agency, and have other states adopted that, and has it worked out well for them?
There's a mix across the country of how the FAIR plans are set up. I believe there's 36 states right now that have a residential insurer, or a residual insurer, sorry, a residual insurer in the state. I think it depends on how it's set up, right? Unfortunately, I don't think there's one easy answer to how we should manage this going forward, but there has to be, we have to look at it from all sides. So it's not an easy answer that I can say yes or no, being a state funded or a state agency would help. We're just looking at the way things are working today. It's not working. So we have to look for other solutions.
So last question. Yesterday, Allstate indicated that they would likely start offering policies again in certain areas that they previously declined. If the proposal from the insurance commissioner were adopted, that is, that the long-range climate model could be taken into account, that reinsurance could be purchased. Consumer critics said, well, but what about rate regulation under that new scheme? So what effect would the insurance commissioner's proposals have on the rates by fair participants? In other words, would they go up by 10%, 50%? Because this is a residual market. I'm just looking for order of magnitude, not precision.
It's hard to say, and especially right now because our book is so diverse in terms of where our homes are located, right? I think coming in, our new business coming in September, 40% of it was coming in non-wildfire areas. 30% of our book overall at the end of September of last year was in non-wildfire areas. So it's hard to say because what we're trying to do is take into account the rates and the rate need in the wildfire areas, but we have a substantial part of our book that's not in wildfire areas. So in order to kind of spread that risk, we haven't done that analysis yet.
So, but it would be safe to assume that your rates are going to go up at a far higher rate than the admitted insurers because you're insuring higher risk areas and your exposure per insurance plan is higher.
It's hard to say without a full analysis, but
Well,
I understand your reasoning. I understand your reasoning and what you're saying. Our rates are gonna go up, no question about it. If we can put net cost of reinsurance in there, if we can use catastrophe modeling, just like the voluntary market, our rates are gonna go up. What I can tell you is our last rate filing, which was 2.5 years ago, we had a rate need of 78 points. We filed for a rate increase of 48.8%, and we were given 15.6%.
That's helpful. Thank you.
Yeah.
Thank you, Commissioner Garcetti.
Ms. Roach, thank you very much. And I did read what you wrote. It was very helpful. Thank you. And please understand my questions are from a novice who knew nothing about insurance, period. My wife handles all the home insurance stuff, and I didn't have any business. So with that said, I was listening carefully to what you just said, and you referred to your response to the question, what happens if you run out of money? You say you assess the market. Now, what does the market mean? Are those the insurance companies who are actually doing business in California in one way or another? Or is it those who maybe have a little finger in it, but have already said, we're not going to be in this business any longer in home insurance?
That's actually an excellent point of clarification. So when I say the market, I mean any admitted carrier in the state who is insuring residential or insuring property risk, could be residential or commercial property risk. So, and if we were, after there was a catastrophe today and we had to assess, we're going to look at companies and where they were in 2022. So we go back 2 years and we say, what was company X's market share in 2022? And if their market share was 2%, they would get a bill for 2% of that assessment.
Oh, good, good. And if they're no longer doing business in California, is an enforcement mechanism to collect that 2% if they don't want to pay?
It's still, we still send them a bill. We did have a company argue in court with us the last time we assessed, which was in the early 90s. And said, we're not doing business in California, but the way the statute is written and the way the assessments are set up, they still had to pay because they had property risks in the state in the time period that we were looking at market share.
Okay. Now, if you totally run out of money and the insurance companies say, we just can't afford this, we'll just stop doing business, period. Is there anything in the law that requires the state now to step in? Or would that take a new act of legislation?
Yeah, there is not at this point.
Okay. The rates, you say, have to be approved by the insurance commissioner office. or
Yes.
maybe the insurance commissioner himself, he has to do it. You seem to be in your comments, in your written comments, hopeful that this is being done, but you don't articulate exactly what it is you are asking for. I don't know if this is somewhat secret or, okay.
So we're asking for the same things that they're talking to the voluntary market about, which is we need to be able to include all of our expenses when we do our rate making, which means that we need to be able to include the net cost of reinsurance as one of our expenses as we look at how much rate we need. And we also need to be looking prospectively at losses, and so we need to be using catastrophe modeling to in our rate making, so we can look at what we believe will happen in terms of losses and make sure that we are set up financially to handle that.
You've indicated that any rate increase must be first approved by the insurance commissioner's office. Since I was not the one handling this, I asked my wife, said, what are we paying for home insurance? Now, we live in an affluent area, and said, go back to 21. It's gone up 50% for ourselves. All right, we're lucky we can afford it, even though it's an outrageous number, but there are going to be many, many people in this state. Think about the older couple who live on Social Security, own their own house, and now their insurance bill doubles, triples, whatever it's going to be. I mean, that's an issue that I think this commission has to look at in some way. And I don't know if you have any thoughts or feelings about this, but there's tragedy, potential tragedy out there that I can see with, I mean, the huge increase of insurance costs that are coming. And I'm not saying that some of this isn't justified. You go back to David Byer's comment about the Chronicles article yesterday. They also had a map of where the big fires were, and they were all in the areas that he pointed to or alluded to being areas that, why were they given permission to even build there in the first place? So we are carrying all those costs, and I don't know what can be done, but I'm concerned about those families. And there are going to be many, many families, thousands throughout the state, who, when they get their insurance bill, are going to say, we can't afford insurance. So they're going to go without insurance there. Do you have any feelings or anything you can share with us that will ease some of our concern?
So I too, like you, pay for insurance, right? Here's what I can tell you from our own experience at the FAIR plan. Are we looking at substantial increases for some people if we add the net cost of reinsurance and catastrophe modeling into our rates? That's very possible, right? And we'll work with the department to move that in over time, right? So people aren't hit as much up front. I think the issue for us is that we haven't been able to get our rates in a timely manner and at the rate we needed. So it compounds over time, right?
Yep.
That's what we're looking at
Right.
at the FAIR plan. I'm sure if you ask the voluntary market, the trades, they'd be able to tell you kind of what they're looking at in terms of rate increases. But for us, it's an issue of we haven't gotten our rates over the past, however many years, 5 years at least since I've been here. And so in order to bring our rates up to the right level, there's going to be a substantial increase. That's as much as I can share, that's how it's affecting the FAIR plan.
Okay, so are there any other changes you're asking for? For example, in my conversations last night, I called a friend who lives in a very affluent community, but it is also a high-risk fire community.
Mhm.
And his insurance company said, we're out of here. They left. So he went to FAIR plan, and he was able to get it, but it was almost twice as much as he was paying and for much less. It's no contents. You go on and on, with the various things, he wound up covering it with other insurance, but again, more money.
Mhm.
So are you in competition in any way with the insurance companies when you're negotiating with the insurance commissioner? Because if the insurance company gets the rates and they said, all right, we're all coming back, or we're all going to be issuing home insurance now again, does that take away some of your need for additional assets and resources? In other words, you need more than $15 billion. We really need $30 billion or whatever the number is, but now because the insurance companies are all coming in, they won't be coming to us. That is, the people will not be coming to us in the fashion that they have since.
Right, I mean, there's a lot of factors contributing to this, right? But I guess the easy answer is the fewer number of risks we have, the less exposure we have, the less need we have for reinsurance, because we don't have as much exposure, because that's based on our exposure. Those prices come down, which means that we don't need as much rate. It doesn't change the fact that we're a high risk pool and that we need rate for the risks that we do have. But this exponential growth that we're experiencing right now further complicates the situation, and it adds to that need for rate and that need for higher levels of reinsurance because our exposure is so high.
Okay. Last question.
Mhm.
Maybe a difficult question for you to answer publicly or privately, I'm not sure. Your relationship with the insurance commissioner's office. Is there anything that you would like to let us know about that might be helpful in when we look at this and decide what recommendations we're going to be making?
So I think for us, as I said, we're committed to working with the department. I think the department is committed to working with us. They're also working, I understand, with the trades to represent the voluntary market and what they need. From our standpoint, I think we just need things to move forward, right? There's there's just not one easy answer, and there are a lot of pieces on the table right now, and we need to start moving forward and put some of those pieces in place so we can all move in the same direction.
Okay. Thank you. I'll call you privately later.
I'm busy.
I understand Commissioner Aaroner has a question.
I do. Good morning, everybody. And I'm sorry I didn't hear your opening statement, but I had read it also, Victoria. So I'm one of those folks who last week got a notice of non-insurance from AAA, right? I've been a customer of AAA's now for 60 years. All right. Started very young with car insurance, obviously, and I bundle with them. So one of the experiences I just got is I also got the letter from the California Earthquake Authority that they will no longer insure us either because our house has to have home insurance in order for the CEA to continue whatever, right? But the interesting thing I got from AAA was that they have kind of a test, right? In regards to forest issues. And so I live in a zone. I live in the Berkeley Hills, right? And when Commissioner Garcetti said, "Well, wait a minute, what about people? What are we going to do about people who live in the zones, right, where it's difficult?" My house is 109 years old. Everybody. It's like nobody was talking about insurance probably in 1908 or 9. All right, our house was the only house in that area. Believe it or not, I have a picture of our house all by itself with dirt roads. And so, what I'm interested in is that because it's the test that they have is called wildfire fuel sources, right? And then they talk about. And they're using a vendor to do this, right? They're not using it, and then they're not doing it internally. They're using some outside vendor who is doing this measuring for them. And so depending on where you are on the scale of 0 to 30, you will continue to get insurance. And it's interesting because 0 to 1 is negligible and low risk of wildfire damage. 2 to 3 is moderate. 4 to 12 is high risk. Our house is rated as 4, not as 12, but as 4. But so what I'm leading up to is there in the admitted, the folks that are here already, is there a common standard that they use, right? Or do they all get to set their own rules as to who they're covering and who they're not covering?
So I think you'd have to go back and ask the market. What I can tell you is there's several tools you can use for those wildfire risk scores, but there's, 3 or 4 that are primary that seems like most of the companies use, but you'd have to really ask them what they're using and how they are determining that wildfire risk score.
All right, but I gathered that you, in the FAIR plan, you don't have the power to do that? That you have to
We
accept
do.
anybody? So tell,
We
so how
don't
does
use it. Sorry, go ahead.
Well, so let's just for the purposes of today's discussion say Dion Aaroner cannot get insurance from the regular market, and the voluntary market for some reason, right, which I'm obviously approaching, all right? But if I approach you, how does it work for me? What happens to me?
So we also use wildfire risk scoring tools, but we use them for rating purposes, not for eligibility. So if you came to the FAIR plan, the fact that you're in a wildfire zone 4 would not impact whether or not you'd be able to get insurance with the FAIR plan.
Well, all that it would impact is how much I'm paying for it, but not that I can get it or not.
Correct.
And then the question is, can I afford it? Okay, all righty, I get that. Thank you. I'm just trying to figure this all out because it's, it doesn't happen to you and then it happens to you. And all of a sudden it becomes very personal.
Exactly.
And so, but is it also, I gather it's also true that in order to get a mortgage in California, you have to have home insurance. Correct? Okay. And that's another limiting factor that's been introduced by Mr. Garcetti and Mr. Cannella and Mr. Beyer, actually, in regards to this issue of affordability and what happens if somebody can't afford it and they have no choice, they have a mortgage, right? They either stand to have to sell house, lose house, or whatever because they aren't able to do that. And their last resort is you. And because they're in a fire area, right, or, is the issue only fire, or is the issue, what about flooding, for example? Earthquakes, we have CEA, so I get that, but what do you also insure around flooding?
We do not take flood zones into account when we determine eligibility for rates. So, there's flood insurance through the National Flood Program. So we don't cover flood losses, but if you're in a flood zone, that won't impact your ability to get insurance with the FAIR plan.
Okay. Is that true? Is that true of the admitted insurers right now, that flood insurance is not the issue, it's just fire?
I hate to say this, you'd have to ask them.
Okay, thank you.
Thank you. I see Commissioner Garcetti has his hand up.
Yeah, one other question I might, Ms. Roach. You've indicated both in writing and here today several things that your agency needs. But if you could only have one, what is your very top priority?
Including the net cost of reinsurance and our rates.
Yeah, thank you.
Yeah, hi, this is Pedro. You mentioned that you have $320 billion in exposure currently, correct?
Correct.
And one of the questions that I ask from time to time is, and with the FAIR plan, what is the amount of premiums that you are collecting annually?
So annually, we just now, our premiums are over $1 billion.
And looking at your bio, you have a fairly extensive history in the insurance industry, including familiarity with underwriting. But as it relates to the overall admitted carriers in California, do you know how much money they obtain a year in premiums for homeowners insurance?
So the Department of Insurance puts out statistics annually, but I believe for sure we haven't seen the 2023. I'm not sure the 2022 statistics are out online. They're on their website.
Okay, and let me ask, just Ethan, I don't know if you've taken a look at that, but at some point I'd like an answer as to what the overall premium collection is for at least for whatever's being reported by the Department of Insurance. Now, you also, Ms. Roach, I think I heard you say you've had 2.5 years that you've been waiting for a response from the Department of Insurance with respect to a premium adjustment. Is that correct?
We did get approval. So we did get approval for our rate increase of 15, I'm gonna say 15.6, 15.7, right around there. It was over 2 years with the department before we received approval, but we did get approval.
And I take it a consequence of that is that instead of increasing premiums in a gradual manner, you then, in order to be made whole, have to impose the full 15% increase as compared to maybe getting 7% a year.
Yes. Yes, so that's what I mean by compounding effect, right? If your need grows, if you're not getting those increases when you need them.
Okay. And as it relates to, and Commissioner Garcetti has raised this, for those homeowners who have mortgages and banks are requiring insurance to cover the investment, have you seen consequences of individuals having to give up their home because they could not afford the premiums for homeowners insurance while they had a mortgage?
We have not. I mean, we've had, discussions with realtors and talked to people about it, but we have not heard people tell us they had to sell their home because they couldn't afford insurance.
Okay. And if we were trying to figure out the frequency of that, is there any particular place that we would go to find that you know of?
I do not off the top of my head.
That's a question. Again, so much of what we encounter are issues with respect to collection of data, whether it's being collected at all, which makes it a little bit more complicated to fashion public policy and recommendations. But thank you. Let me turn to the commissioners that are here. Do you have any further questions or comments for Ms. Roach? And I want to thank you, Ms. Roach, for you have a very difficult job as president of the California Fair Plan, but it seems to me that based on your training, your experience, and your familiarity with the industry, we're well served by the talent and skill that you bring.
Thank you.
Anybody else? Oh, you're welcome. All right, seeing none, thank you. Let me turn it back to Ashley. I do understand that we have another witness available.
Yes, our next witness is Mark Ghilarducci. Mr. Ghilarducci is President and CEO of Emergent Global Solutions, a global crisis and emergency management firm. Previously, he served as Director of the California Governor's Office of Emergency Services from 2012 to 2023, guiding the state's emergency response to catastrophic wildfires and other disasters. Mr. Ghilarducci, you may begin your testimony when you are ready.
And excuse me for interrupting, Mr. Ghilarducci, but I do want to remind the commissioners that I understand that Mr. Ghilarducci, we have him until 10:15. And after that, he's got another obligation. Thank you.
Good. Well, thanks, Ashley. Good morning, Chair Nava and Vice Chair Canella and all the members of the commission. It's good to be with you this morning and have an opportunity to spend a little time talking about the issue related to insurance and the crisis that we're facing. I think I'll start off by saying that really speak to the time I served as director of OES, just most recently the immediate past director. During my decade of service, I really had the opportunity, I guess you could say, of dealing with multiple events, multiple catastrophic events, including 15 of the most destructive wildfires in California history, 2 of the most destructive in the US history. So had unfortunately the opportunity to see the impacts of a wildfire and how the cascading impacts affected the insurance industry. During my tenure as director, in response to all these wildfires, I hosted a series of joint meetings with the banking and insurance industry. While these meetings were held in consultation with relevant state agencies and departments, the meetings were also held in a manner that allowed for open and candid discussions outside of the presence of a regulator. I'd also like to point out the significant interdependencies that existed, and we found and learned that existed between the insurance and banking industries, as they each rely on each other, and both the banks and insurance companies are institutional investors that provide a amount of capital investment into the global market space. The purpose of the meetings that we held, these series of meetings, was to really discuss innovative ways to assist disaster victims, ensure that policies were being paid to policyholders in a timely manner, and to allow a forum for the state and for the insurance industry to share issues and discuss solutions for current and future disasters. Several practical issues and findings came up during these meetings that I did share with the commission in my full statement for the record. As the climate impacts that we're experiencing continue to have an impact on response and recovery to disasters and the California insurance market. Communication and coordination between the insurance industry, financial institutions, local and state government, and the public is essential to long-term recovery. Survivors cannot obtain a construction loan to rebuild or mortgage loan to buy a new home if they have not yet received the payout from their homeowners insurance. Since it is clear that these devastating disasters will continue, fostering individual and community preparedness and pre-disaster consumer education, including risk and vulnerability data, will help increase the number of adequately insured individuals in future disasters. The insurance industry needs to engage in advising on what the future of resilient construction and homes and communities should look like. Many disaster survivors are unable to obtain an insurance policy now or an affordable policy for a home that has been rebuilt after a disaster. In many cases, obviously, as we know, pre-disaster, as the insurance industry is pulling out of California, many people are losing their policies prior to the disaster occurring. This was an issue that the insurance companies actually knew about and were dealing with even prior to beginning to pull out from the California market. Insurers really should consider amplifying, partnering with communities, governments, and individuals. This is really a whole of community approach to offer that collaborative building of a culture of preparedness within the communities to buy down the overall cost, to buy down the overall risk, to offer fire prevention incentives to existing and or potential policyholders that have been identified as meeting fuels, hazard reduction, structural, building material, defensible space, and other fire prevention and mitigation actions. Currently, the legislature is considering a bill, SB 1060, that would enable and accelerate this initiative and or these initiatives, and would also further benefit and enhance the state's current implementation of the California Wildfire Mitigation Program, a program which I championed during my tenure as director and was implemented as part of the state's effort to strengthen community-wide resilience against wildfires. This is a state-led home and community hardening initiative to assess, retrofit, harden, and create defensible space for homes and communities at high risk to wildfire, specifically in vulnerable communities, which was authored by signed into law by Governor Newsom in 2019. Programs like this really do offer a perfect opportunity for the insurance industry to partner and capitalize on government-funded initiatives, innovation, and education to further amplify efforts to buy down the risk and build a culture of preparedness on the part of policyholders and communities at large. These public-private sector partners can also form key partnerships to enhance public education in order to increase the homeowner insurance education, individual and community preparedness, and personal responsibility, as well as develop and implement programs between insurance companies, the California Department of Insurance, and other relevant stakeholders to include public safety agencies. Again, the whole of community approach. And requirements could also include information on specific items which are and are not included in multiple types of insurance coverage, and which actions can be taken to receive discounts and certificates to be able to make this more affordable and a collaborative approach. This homeowners insurance crisis and related cascading impacts we are now experiencing offers a powerful incentive for the insurance industry to rethink its approach to the criticality of hazard mitigation, and for communities, individuals, and insurers to invest in pre-disaster preparedness and prevention actions, and to reduce costs and the overall impacts of climate-driven disasters. These efforts must be prioritized by insurers and governments alike and baked into the whole of community approach tied to community hazard mitigation plans, general plans, housing design, and construction and infrastructure projects on the front end of any development taking place. Being in the business for more than 40 years, I've worked on some of the most challenging and complex crisis situations, from terrorist bombings to major earthquakes to climate-driven catastrophic wildfires, which has resulted in where we are at today relative to the challenges of affordability and availability of homeowners insurance. I thank you for taking the time today to hear me and this testimony and the opportunity to share my perspective. Happy to answer any questions and continue to help the state and the industry in resolving the homeowners insurance crisis in any capacity. Happy to answer any questions.
Thank you, Mr. Ghilarducci. And I should just mention for our commissioner, we've got Commissioner Aaroner followed by Commissioner Byer. But you know, I first met Mr. Ghilarducci when I was in the legislature, and I authored the bill to combine the Office of Homeland Security and the Office of Emergency Services, because at that time they were separate entities, and the Office of Homeland Security was essentially created by executive order because it was a hurry-up deal in order to make sure that we were eligible for federal funds. But I will tell you, back in those days, there was absolutely no transparency with respect to Office of Emergency or Homeland Security. And it was almost impossible to track any kind of budget activity that was going on. And once we were able to combine those and Mr. Ghilarducci came on, he soon discovered that the Office of Emergency Services soon became the go-to place for every possible problem that didn't have a home. And if you're looking for somebody, right, somebody who represents the sort of Mr. Fix-It and Swiss Army knife kind of approach, that's this gentleman right here. So let's turn to Commissioner Aaroner.
I have to.
You're on. No, you're unmuted, Commissioner.
I'm unmuted? Oh, it doesn't show that. Okay. Anyway, Mark, hello. It's nice to see you again.
Yes.
And I agree with what Commissioner Nava just said, right? You were the fix-it guy to go to, no doubt about it. So I was really interested in your testimony. I read it ahead of time. So I guess, first of all, are there any examples that we have of this actually taking place? I'm thinking like of the fire in Santa Rosa, right? A whole community on the west side, I think, of 101 was destroyed and has been rebuilt. And the same thing with Paradise, right? So as they've been redeveloping, is anybody putting together anything like you are talking about? So, because I mean, I've always had a question about the folks in the Russian River area, right? The Russian River overflows, what, once every 5 years, right? Something like that. The homeowners have, terrible problems and everything, and they rebuild. And we reinsure them again, and it goes on and on and on and on. And so it's this issue, of course, of where's it appropriate to build, and I get that. But it's historically to say to somebody, I'm sorry you can't come back to your neighborhood that you've lived in for the last 60 years, probably is not going to fly. And so is any modeling going on anywhere in the country, right, in regards to this whole preventive kind of idea? Because it seemed to me certainly that would engage, it would be important to the insurance company. Why wouldn't they be promoting these kinds of things?
Well, it's a great question. And, first, let me say that in California, over the course of the last several years, really driven by all these catastrophic wildfires, really starting in the 17 fires, you mentioned Santa Rosa, and moving forward, there has been a lot of government action. There has been a lot of action to increase and enhance building and fire codes. There have been increased efforts to build better evacuation routes. There have been increased efforts to build hazard mitigation into the general plans of communities, and also the ability for that mitigation efforts to harden not just the homes, but communities at large. The governor and the legislature have put significant amount of resources behind doing that. I would also say that the insurance industry has also engaged in more mitigation efforts in the wildfire space, but still, I think, falls somewhat short with regards to the ability to recognize the efforts that individuals and communities have taken to build mitigation efforts and harden their communities, by recognizing that insurance should still be provided to that community, or in fact, if it's being provided, should be reduced in cost because of credits they're get given for mitigation efforts. I mean, it really needs to be a partnership, and I think that more work needs to be done in that area to build that partnership, that recognition. The other thing is, as I mentioned in the testimony, there are details, and that we say the devil's in the details with regards to post-disaster events, in being able to make sure that insurance companies and the bureaucracy of insurance companies get streamlined so that individuals can get the insurance that they've paid into rapidly and gets their community rebuilt, their homes rebuilt. This has been a problem. It has an economic cascading impact, not just to the individual, but to the community and to the state at large. Part of the issue, as you all have heard, I'm sure, is that, the modeling, when can the insurance companies do catastrophic modeling? And, the issue is that, in California, it's not really done by regulation on the front end. And this is one of the issues where there's discussion in moving it so that on the front end, insurance companies can do these catastrophic models, take the models, and then build rates and insurance models around what the greatest risks are. I think it's a fair assessment as long as it's transparent and people understand, and everybody understands if I'm the homeowner and I'm buying insurance, how that rate has been achieved and what I get for it. And if I've done work to mitigate the threat, I should get credit for that. In other parts of the country, to your question, they do risk modeling on the front end. And when we see hurricane-prone states or other states that have higher degrees of, different, very few states outside of Western states really have the wildfire problem. But I will tell you, with climate change, we are seeing wildfires spread in states historically that we've not seen wildfires in before. And so I think that insurance companies, of course, are looking at that at large. So a little bit of long-winded answer, but to your multi-part question. But the fact is that there is some initiatives we need to formalize and move that forward. I think by building a culture of preparedness within the community, where we think about that on the front end, when we're building, when we're developing a development, or individuals that live in a WUI, a wildland urban interface or intermix, they do work to buy down the risk. The reality is we need to have insurance that's affordable and that does make a coverage. The other one point I will make is that over the course of time, I think, based upon inflation, based upon the cost of materials, the cost of rebuilding a home after a disaster, many individuals, because they're just not educated by their insurance provider to the degree that I believe they should be, do not increase the value of their insurance. And so when the disaster happens, even though they have full replacement on their policy, when they get to the disaster, they realize they fall significantly short in their ability to rebuild, and that becomes a major problem, in the recovery process. So there's many complexities, underserved communities, elderly, people who have paid off their home and lose their home, depend on the insurance. If I'm a senior citizen, I'm now not going to want to go back out and get a big loan to rebuild my house and carry that loan, for years, and maybe transfer that loan liability to my children. So there's a lot of complexities that still need to be worked on, where the insurance industry, the government, and the communities come together to build a collaborative solution to some of these problems.
Is it true that California's actually home insurance rates are much lower than in other states? Because, maybe it's because of Prop 103, I don't know.
I know that it is an argument that is made by the insurance industry that because of the regulations that exist here, they can't, I would say, adequately reflect the rates that are necessary to meet the threat that is that they're facing, and that's why they want to do the modeling on the front end. That's why I think it's, other states do have modeling on the front end. I'm not sure about whether or not where we compare today with insurance rates across the country. I would say that there are other states like Florida and Louisiana where there's been significant increases in insurance rates as well, particularly due to the threat that we're seeing from the climate-related challenges. I mean, disasters are more extreme than we've ever seen before, and they're more frequent. When you think about that and you amortize it across the country, the question I would have, and I have, is how prepared are we on the front end from a scientific, from a data development, catastrophic modeling, how much of the industry, and it's a little bit rhetorical because I know they're doing the work, but how much are we prepared for these climate-related challenges and the future climate-related challenges that we know are going to be with us for the next 20, 30 years. We need to be thinking about it differently to be resilient as a community and as a nation.
Great, thank you so much.
No, thank you. Before I go to Commissioner Byer, I think one of the things that we as the commission can look to is when we did our forest management study, we also called for the kind of thing that Mr. Ghilarducci is discussing, and that is you get all the people in a room, and it may on its face seem very unwieldy, but they figured it out. And I think that some of the progress that was made in forest management and the application of science and getting people to talk to one another was brought about because they had a place to go, and there was an incentive, and it had to deal with the wildfire issues. There's also, and I think we've seen this, what happens in disaster areas once the fire is put out and it's time to rebuild. You have a shortage of qualified workers, and you suddenly find that the hourly rate for those that are available is twice as much as it was before. Add to that, and I think this is something that we don't often talk about, the cost of materials now is higher than it had been 1 to 2 years before, as well as supply chain issues. So when Mr. Ghilarducci says it's a complicated problem, he's right. And the call for all of these players to have conversations at the same time in the same room becomes even more paramount. Commissioner Byer.
Thank you, Mr. Chairman. And I want to thank the witness for his government service. That's more than a platitude. At the federal government level, there are awards called SAMMys after Sam Heyman for Best Federal Employee. And it sounds like you've been nominated twice here this morning for your service for the state of California.
Thank you.
The breadth and depth of your work is frankly astonishing. So thank you for that. My question relates to where Commissioner Nava went with forest management, and it really speaks to not an all of community, not insurance companies and government, but rather all of government. That is, in your experience, have there been meetings led by the governor or the governor's top people in the horseshoe around what I'm going to call the housing dilemma, because I think it's bigger than an insurance problem. And let me explain. From a diversity, equity, and inclusion point of view, there are millions of Californians who live in rental properties. And the rental properties have to be insured, but it seems like there's some serious impediments to securing affordable insurance in the rental market. So my question really relates to, has the state government holistically looked at the relationship between the availability of housing, especially for low and moderate income people, and homeowners or rental apartment insurance to determine whether that disconnect is forcing people out of housing, creating homelessness tensions, or making home payments in the form of rent unaffordable, putting pressure on people to survive. And so I guess what I'm asking is, when you think about emergencies, you tend not to think about people renting apartments. But to me, they're connected, and it's the behavior of the state government vis-a-vis renters that I think we could focus on. And my question is that something that the executive branch has undertaken in a holistic way?
Commissioner Byer, thanks for the question. And it is an area where, let me just say, in dealing with many of these disasters that have impacted communities, people who are renting are looked upon. It's not looked upon differently, but if they don't have a renter's insurance policy for where they're renting, they don't have, and the building is destroyed or damaged. It's usually their responsibility, not necessarily the owners of the building. The owners of the building could also have insurance for their building, to protect their investment. But to your point, we do think about those. We do address them with regards to DEI. Whether how we approach them, because many renters do not have renters insurance. And so they lose all of their belongings, and then they are taken into account with regards to if we do get individual assistance from the federal government, if it becomes a federally declared disaster, they're eligible for getting financial aid to replace their items that have been lost. And predominantly it's the items that have been lost. They don't own the home. So it's really the items that they own, their commodities. And if we don't get to a federal level disaster, then my previous office, the Office of Emergency Services, did have a program through our Office of the Public-Private Integration, where we worked with nonprofits, community-based organizations, and others to help individuals that fall into the category that did not have the resources to support themselves and or have lost everything. And we help them not only get into a immediate housing solution like a rental or possibly a hotel for a period of time, but help them with key items that they've lost, and help them with their paperwork and all those kinds of things.
So I guess what I'm reflecting on is, in our first hearing, we heard from a witness about a $20 million limitation on apartments, which seemed to make no sense at all. In your view, are large structures, that is structures worth more than $20 million, adequately insured? And if they're not, wouldn't it be logical for those apartment owners to self-insure? And in doing so, they're essentially putting a financial burden on themselves, driving up rent costs. In other words, is there an insurance problem for apartment buildings?
Yeah, I got your question. I understand it. I guess I would say, I've heard that there's a cap. Now, I'm not in it,
Right,
I'm not,
that's what we heard
I
too.
don't sell insurance, so I don't know exactly for sure whether or not that's accurate or not. First, I've heard of that. I've heard of apartment owners. And again, if you're an apartment owner, you're considered a business. So it's a different kind of insurance than, a homeowner's type of insurance policy. So I think from my experience now, I've seen people who have been woefully underinsured and have apartment buildings, and they've just not invested in that because they didn't pass the cost along to the folks living in the apartment. Or I've seen them fully insured. I've seen them overinsured actually in some cases. So I don't know. I mean, I think that most people who have insurance in apartments like that do pass the cost on to the renters. If it's an underserved community or they're under rent control, that could be a potential problem. And they can't pass it on to the people living there, and so they don't get the amount of insurance that they need. I mean, which potentially could put more people. I mean, when we lose an apartment, we lose several, homes in one sweep that we have to put people in and deal with. And if it's an underserved community and we don't address it immediately, those people can be in very dire straits, and we want to make sure that that doesn't happen.
Okay, so just to summarize, you, in your previous job, provide temporary assistance either with the federal government or from state funds. But this question of the relationship between insurance for multifamily housing and low income or moderate income housing is not the subject of a statewide all of government analysis.
I would say not to the degree that we're looking at the totality of, we're looking at the totality of the insurance problem, and we're looking at communities. If an apartment building is part of our initiative of hardening a community, we want to look at the community as a whole, then we would look at it. But I would not say that we have a specific initiative looking at multifamily housing. I mean, let me just say that there are a number of individual initiatives, for example, in hazard mitigation, communities getting hazard mitigation grants, or apartment owners applying for hazard mitigation grants to be able to help retrofit their structures to make them more resilient. What we did at the California Earthquake Authority of brace and bolt to be able to make them more seismically retrofitted. What we've done in the wildfire mitigation program to help them become more fire resilient. But to say specifically an initiative looking at multifamily homes, from the context of the insurance and the wildfire, I don't think that I remember of that actually happening.
Thank you.
Commissioner Garcetti.
Ghilarducci, you and I have never met before, but after reading the comments that you gave in writing to us, you can't help but be impressed. And it doesn't surprise me that my other colleagues have spoken highly of you who have worked with you. I don't know if you've ever testified before the Little Hoover Commission, but you certainly, I'm sure, are aware of how we function and we work. We do our research. We invite particular witnesses to testify who have much more knowledge about the issues than we do, and then we question them. And then we write recommendations. This is your chance perhaps to share with us the one or two recommendations, even three if you have them, recommendations that you really hope that we address and maybe even make. So that's my question to you. What are those 1, 2, or 3 recommendations?
Well, thanks, Commissioner Garcetti, and it's great to meet you. I've actually followed your career for some time as well. So thank you for your service. And I thank everybody for all their accolades, but remember, it's a team approach. So I work with some fantastic colleagues and folks to make all this happen. I think that from the standpoint of where I have sat in my previous job and where I've seen the impacts is that we are not doing enough collectively. There's a term I used to use when I was director: one team, one fight, right? We have not been doing enough collectively to build that public-private partnership. Look, we are facing an existential threat with the climate changes that we're seeing. These are going to get worse. We need to think about how we build, where we build, how we insure, how we educate. We need to evolve into a pre-event culture of preparedness, which includes clearly the insurance industry engagement. And let me be clear here. I am not here saying the insurance industry is not doing anything. I mean, they are. But there's so much more that needs to be accelerated in this space, because it's not just the government's problem, or it's not just the homeowner's problem who decides that they're going to go move and live in a wildland urban interface area. Not fair to penalize them. And quite frankly, now that's just extended to almost many people. I was just talking to a colleague who was paying $1,000 a year for their home insurance, and now they're paying, in the course of just a few years, $9,200 a year for their insurance. It's unfathomable. It's not sustainable. And so we need to find, and Chair Nava mentioned it, is getting people in the room, getting them to work through it. And I have found, and that's why after these major wildfires, I pulled in the insurance industry, the banking industry, the government, the nonprofits, and brought them around the table and said, look, what is the pathway? How can we do it? We came up with some great nuggets. We connected the banking industry with the insurance industry to rapidly address issues that were not being addressed before, because you're just caught up in the way you look at things individually. So I would just say my biggest recommendation is that we accelerate the process of this collaborative approach of hazard mitigation, and then through that, risk modeling on the front end that is transparent, so that we can all understand and learn where we live, what risks exist around us, and how best we can help in that effort to mitigate those risks. And then the insurance companies, rewarding that with a lower rate, because everybody's out working together on this. And I think that those would be things that, and I guess there's, obviously lots of complexities associated with that, and details about having that come together. I think there are many things that are challenging the insurance industry right now, but picking up their program and leaving the state and leaving people at risk is not the solution to this issue. And so I would just ask that we work to bring this. And there've been initiatives. We need to do more of that moving forward.
Thank you very much. And for me, the key word was transparency. Thank you.
Thank you, sir.
Thank you. We've got Mr. Ghilarducci for another minute. Let me take a look at fellow commissioners. Any other further questions or comments? Seeing going once, going twice. It's like an auction with you, Mark.
So,
all right. All right. I want to thank you so very much for taking the time to coordinate with staff and for your testimony and for the experience that you bring. Thanks again.
Thank you all very much. Have a great rest of your day.
Thank you. Ashley.
Thank you. Our next witness is Laurie Johnson. Dr. Johnson is principal at Laurie Johnson Consulting and Research, which she founded in 2006. She is an internationally recognized urban planner specializing in disaster recovery and catastrophic risk management. Her work blends earth science, urban planning, and public policy to help communities, the insurance industry, and other organizations address the challenges posed by natural disasters. Dr. Johnson, you may begin your testimony when you are ready.
Thank you, Ashley, and good morning, commissioners. It's an honor to speak with you. I spoke with you once before, coincidentally with Mark on the same panel back in 2006 when you were looking at the state's readiness for a catastrophe similar to Hurricane Katrina that had just struck on the Gulf Coast. I have some slides if those could be pulled up. While my remarks may draw upon my knowledge and experience working with the California Earthquake Authority, insurers, and CAP modeling companies, my views and opinions that I'm going to share today are solely my own.
Dr. Johnson, I believe we're going to pull up those slides now. Ashley, if you can do so, please. There we go.
Great. Thank you so much. Thank you. Thank you. So I'm going to start first by talking about the CEA. It was born out of a similar homeowners crisis after the 1994 Northridge earthquake, and so it's a valuable data point for the commission to study, really, as to its strengths and weaknesses of the structure and its effectiveness to date. One key aspect, next slide, please, of the state's formative legislation is the requirement that the CEA set aside a small portion of its investment income, up to $5 million annually, for mitigation funding. That capital helped spawn the California Residential Mitigation Program that Mark just talked about, the Earthquake Brace and Bolt, which has now attracted more than $100 million in funding from FEMA, Cal OES, the state legislature, and others, and more than 23,000 older, seismically vulnerable homes in the most earthquake-prone regions of the state have been retrofitted as a result. Next slide, please. The CEA is one of many government-created or government-backed insurance programs that have largely been created because of private market insurance gaps and crises. In the US, there's also the National Flood Insurance Program, the Florida's Hurricane Catastrophe Fund, just to name a few. In 2006, CEA helped form the World Forum of Catastrophe Programs for the voluntary exchange of ideas, expertise, and practices among these public insurance and reinsurance providers around the world. Most of these programs, I want to point out, are dealing with the same financial challenges as the CEA and homeowners insurers are, in that inflation is increasing the insured value of policies, and there is decreased capacity and rising costs of global reinsurance and risk transfer markets. Like the CEA, most use catastrophe risk models to price and manage risk, and many offer incentives or take into account hazard mitigation actions that enhance individual property and portfolio resilience, both of which are core elements of the State Insurance Commissioner's Safer from Wildfire Guidelines and the Sustainable Insurance Strategy. Next slide, please. Speaking specifically to the Commissioner's draft regulations on the use of catastrophe risk models, fire is definitely a challenging peril to model, but peer-reviewed studies and methodologies have existed for many years. The key components of fire models are ignition, source types and rates, fire spread, and fire suppression. The opportunity that we have with fire compared to other perils like earthquakes or tsunamis, tornadoes, and hurricanes is that our collective mitigation and resilience actions can measurably reduce fire damage as well as the fire hazard, the source itself. For example, vegetation fuel reduction and electrical infrastructure resilience investments can reduce the rates of fire ignitions and spread, even in the face of a warming, drier, and windier climate. Next slide, please. I believe that the Insurance Commissioner's proposed regulations for cat risk modeling and hazard mitigation discounts ought to be part of something larger, a more broadly accessible statewide initiative to construct what I'm just going to call a living risk model that would provide insurers, regulators, and CAP modelers, as well as federal, state, and local government agencies, private and nonprofit organizations, and consumers with shared access to the core scientific data sets, hazard maps, and fire damage data that inform risk modeling and scoring, and that accounts for, transparently values, and permanently records the mitigation and resilience actions of governments, utilities, communities, and property owners, among others. This is consistent with a key recommendation by the Department of Insurance Climate Insurance Working Group in its 2021 report to develop a, sorry, I'm having problems here. I'm having a hard time moving you around my screen. I'm going to try to lower you. To develop a publicly available mitigation model that can be used by local governments and state mitigation investments. That is what the working group recommended, a publicly available mitigation model. As this slide is just a quick mashup that I made of the kinds of data that could be included, I also included the logo for HAZUS. It's a public loss estimation tool developed by FEMA for earthquake, tsunami, hurricane, and flood. And it's an example of what we lack and very much need for wildfire. Let me provide a few more brief illustrations of what I mean. Next slide, please. At this commission's first hearing, Dave Jones noted a problem that underwriting rates and models don't account for the risk reduction benefits of the billions spent to date on forest management. For example, the Nature Conservancy and Willis Towers Watson estimated a 41% reduction in residential insurance premiums when ecological forestry is applied in relevant areas. A study by Moody's RMS estimates that Southern California Edison's wildfire resilience estimates can reduce catastrophic wildfire losses by 75 to 80%. At the Insurance Commissioner's hearing this week on draft CAT modeling regulations, one local fire chief stated that his department has documented 97% compliance with defensible space inspections, but residents still can't get insurance. Tracking and accounting for the tremendous investments being made across the state in fire ignition reduction, fire spread vulnerability, and increasing fire suppression capacity and capabilities can help ensure that the data is readily and equally available to CAT modelers and insurers, as well as mitigation funders and agencies like local fire departments, to ensure that their limited resources are focused on the risk reduction actions that will yield the greatest benefits. Next slide, please. As further example, the San Francisco Chronicle recently mapped the areas of San Francisco, Berkeley, Oakland, and the East Bay where an insurer did not renew policyholders due to the risk of fire following earthquakes. Major resilience efforts have been made in these same communities in very recent years, for example, to retrofit earthquake vulnerable residential wood frame dwellings and to install automatic gas shutoff valves, both major causes of post-earthquake fire ignitions, and to substantially enhance fire suppression capabilities, with billions being spent on seismically upgrading the region's water supply systems, local emergency water firefighting systems, fire stations, and equipment. Are these risk reduction benefits being accounted for? There's also other major concern that the problem with the homeowners insurance crisis is moving into the urban areas, and insurers' potential retreat from these denser urban areas can also negatively affect statewide housing and climate goals, targeting infill development and greenhouse gas emission reductions. Next slide, please. Also at the Insurance Commissioner's hearing, numerous speakers recommended that there need to be established standards for modeling and hazard discounts, independent review of proprietary data and models, and the need for a public risk model like Florida has developed, all of which I agree with. A public wildfire model can provide important comparative benchmarks for proprietary CAT models used by insurers, and they can also have an incredible value for state and local resilience project prioritization and funding, hazard mitigation planning, and emergency planning. As a quick and final example, I've been involved with several projects led by the USGS that used HAZUS and other open source loss estimation methodologies to develop valuable scenarios for major earthquakes, tsunamis, and flooding in California. In turn, these scenarios have served as the basis for state and federal catastrophe response plans as just one of many, many important applications. Last slide, please. The tragedy and loss in Paradise in 2018 and other communities around the state should never happen again. And given the millions of dollars of resilience investments and actions, it just might not happen again. Transparently, openly, and collectively measuring our resilience progress and modeling its effectiveness can help ensure that we have a healthy insurance market and that we are investing wisely in community resilience. I stand ready for your questions. Thank you.
Good, thank you very much. I see Commissioner Byers' hand moving up to the screen.
Thanks.
That's usually an indication that he got a question coming.
So, well, thank you for your testimony. It's incredibly helpful and quite substantive. And I want to take my fellow commissioners back to a couple of earlier reports that we issued, one on geospatial information systems and the other on forest management. And if I hear your testimony correctly, there is a data system problem in the state of California. That is, no entity in a transparent, accountable way is keeping track of all the puts and takes about risk and risk mitigation. And it seems as though we've constructed a system that is highly dependent on inputs only from insurance companies who use outside consultants. Nothing wrong with that and nothing wrong with them making money, but that's an incomplete picture. And that's, I think, what your testimony is pointing to. Wouldn't we be better off if there was a mandate for the insurance commission and the state government to collect and make assessments around a broader set of data on resilience and taking into account things that could lower the cost in the future? Isn't that the gist of your testimony?
Yes, thank you. So it's not just about a data management problem, though. It's about the dependence on whom to make an assessment and valuation of the work. So, for example, the Institute of Building and Home Safety, which is an insurance-supported industry initiative, has something called Fortified Home. They've built these giant wind tunnels. They take glazing roofs and they put the houses in these wind tunnels and they test them and they figure out exactly how much value is coming from that particular mitigation action. Similarly, the California Earthquake Authority funded a similar study by the Pacific Earthquake Engineering Research Center to do the same around retrofitting vulnerable homes, to find out exactly how that hazard discount should be valued. The regulations right now, as proposed, direct the insurance industry to value these kinds of mitigation actions, but we don't have the same consistent and transparent understanding of what that value should be. And we can talk about it on a home basis, and that's pretty easy to quantify. But when you're talking about the things that Dave Jones mentioned, which is large scale vegetation, fuel reduction, or, what the electric utilities are doing, unfortunately, it's not just about bringing the data together. It's also really hard to test those things in the real world. And so you actually need models to do that kind of testing, do those kind of what if scenarios. If we put these things into the model, how does that change our assumptions about ignition rates? How does that change, fuels in different weather scenarios in terms of spread and fire rates of spread? And then, all of that before it gets in contact with actual structures and how they're performing with their various types of resilience efforts. So all of this you can actually do. You can do in real life tests, but you can also do them in computer simulations. So It's not just about a data warehouse. It's also about having an infrastructure such as a public open model where we can actually do science, universities, we can encourage a research environment where these things are being tested.
Right. Well, I completely agree. We obviously, as a society, know an immense amount about our social media activities. We know more about what somebody's doing on a minute-by-minute basis than we do about the costs or risks of fire, earthquake, flooding for a home. And my question really goes to, I don't mean this in a snarky way, but a question of competence, data competence, and transparency within the Department of Insurance. They have, if I remember correctly, 3,500 employees. They have a lot of people, but are they well situated to collect, accumulate, and be transparent about the factors they're using in making assessments about relative risk and insurance rates? And what you're suggesting is a much more comprehensive approach than a kind of fast food service model where the insurance department gets an order, that is a request for a rate increase, and they take it in the back room and they assess it, and then some 2 years later they come up with an answer that doesn't seem to satisfy the customer, the insurance company, and certainly doesn't benefit the homeowner who has no idea what's happened. And so you're talking about a data management system, but a decision-making system that's substantially more complete and much more transparent. Have I got that right?
Yes, and I guess I just want to say that I want to encourage that we think about this more as the commission's charge is looking across statewide efficiencies. You know, this is something that many other agencies need as well. CAL FIRE needs this kind of information, Natural Resources Agency, other agencies investing in resilience, Cal OES's program, bringing all of that together in a more unified way rather than looking to, you know, vendors, modelers, you know, who are building these types of products to be replicating their efforts, some getting some information, some not getting that information, inconsistencies in that data collection process, that we have some state leadership that goes beyond just what the insurance commissioner probably has, you know, is within his purview, and looks at all of these resilience efforts and our $1 billion of investments coming across at the state level more holistically.
Thank you.
Thank you. Commissioner Garcetti.
Johnson, thank you very much. You probably heard me say that I'm a novice in this area, and certainly I want to thank you for your written comments and for testifying today because it's been very helpful to me. To me, this is a no-brainer, and that, you know, why aren't we doing this? Why can't we do this? So let me put you in a little tougher position. If you were the governor today, how would you go forward with this?
Well, I'm not, so
I know,
don't want to speak.
If you were advising the governor, that makes it easy. These are
I'll say
you need to do.
a lot of my work has been post-disaster in dealing with breaking down the silos of different government agencies and different, you know, different levels of government and trying to bring them all to work together. This is, you know, I use the term wicked problem. I mean, these are those sort of collective action problems that really do require very top leadership. And in a collective active impact model, that's actually like one of the first preconditions to really have collective action. So there have been, you know, many of you have already served on some statewide committees. The insurance commissioner has hers. I know I know United Policyholders has been running the, you know, a really collaborative cross consumer and insurance industry initiative. These are all really important efforts, but I think that what we have to have is something at the very top. And as the third largest economy in the world, I think, you know, we can build our model. We don't need to wait for FEMA to build our model. And we can actually, you know, unify this. Maybe it sits in an office of resilience that sits in the governor's office that brings together all the agencies that are working on resilience, which I know some task force like that already exists, but maybe it's a more dedicated staffing that has expertise in resilience work across multiple perils. Wildfire is obviously the one we're focused on today, but we've had this same problem in the earthquake space for years. It is much easier for these vendors to go around and, you know, use photography, drones, aerial and remote sensing to see what kinds of roof types that we have put on our houses and how resilient we are to wildfires. It's a lot harder to look at stuff like window glazing with those kinds of tools, or, you know, if we're looking at more like foundational resilience efforts, or the kind of large scale vegetation management and electrical infrastructure types of mitigations that I also mentioned. So it does require, I think, kind of pulling out and thinking much more holistically and crossing across multiple governmental agencies and various silos.
Thank you for that effort.
Yep, thank you.
As being governor.
Is Commissioner Aaroner, are you wishing to speak, or yes, no?
Only that my comment is we need a czar, right? And we've used that term. We've used that term before, right, in the state when we were trying to bring together folks to talk. We had a Medi-Cal czar, if I remember, many years ago, and we need somebody who with some leadership talent to bring everybody together, right? And how do you do cross? You know, we have a problem in the state where very often our departments and our agencies are siloed, and that many of them, as you've just heard from Laurie, are to have resiliency, you know, committees going and whatever, but are they cross-fertilizing with each other? that kind of thing. And so it would seem to me that one of the things we want to look at is how do we centralize this discussion so that we could make some headway in regard to the organizing of it, right? So that people aren't duplicating things, but that they're all bringing information to the table that we need in order to really figure this out.
Thank you. Commissioner Byer?
Just a request to the chair. The comments of my fellow commissioners Garcetti and Aaroner underline the importance of hearing from the Department of Insurance. We cannot proceed with them being silent and not participating. We've got too many questions for what they do or how they should reform themselves. And we don't want to waste the time of the legislature by proposing things that are not a result of consulting them. So I'm hoping that the persuasive skills of the chair will convince them to appear at a future event.
Yeah, those persuasive skills may be overrated, but I see Mr. Garcetti is giving me an out here.
The only out is that I didn't have the nerve to say what David just said. I am in full agreement that we need to hear from the insurance commissioner's office. Ideally, the insurance commissioner. Thank you.
Yeah, I want to thank my fellow commissioners for expressing that sentiment. I also recall that there was a commissioner who asked me to take a look at our subpoena powers, and kind of thinking issuing a subpoena for the insurance commissioner. I don't know that the Little Hoover Commission has ever issued a subpoena. I'm not entirely persuaded that that's the direction that we should go in. I think I have to reinforce that staff has repeatedly inquired of the office to have someone offer testimony. I know that there was a commissioner who has a relationship with the insurance commissioner who directly reached out to him, and we thus far have been unsuccessful in getting a response, and it is extraordinarily unfortunate that there are so many questions. When you hear from the FAIR program, it takes 2.5 years to get a response on their request. When we have testimony from the insurance industry that as it related to auto insurance premiums, it took 5 years. And we will again renew our request of the commissioner. I think it's a mistake to not participate, but I don't know that that we can do a whole lot more than that. I do think for Ms. Johnson, part of, as we talk about the collection of data and the integrity of it and those that participate, one of the things that has to be included in this, and local government is sensitive to it and they don't like it, but there are land use decisions that are made by city councils and boards of supervisors that, whether they like it or not, put people in harm's way. When development is authorized in areas that have already been identified as having specific hazardous components, it is extraordinarily curious to me why those projects get approvals. And perhaps part of what we need to talk about as we discuss homeowners insurance is, what kinds of conditions would be appropriate for an approval at the local level for homes to be built in the WIU, in an alluvial fan area, in a flood zone, in a high fire risk area, because the risk of that is then transferred to the homeowner, who has to turn around and is confronted with an increasingly disinterested insurance industry, who, from their perspective, you're saying, listen, you want us to underwrite, and the underwriting is critical too, because part of what, if we focus on rates, we have to keep in mind that what Dave Jones pointed out is that the big black box here is the underwriting criteria. And the industry doesn't want to release information about underwriting because they talk about, we don't want to give our competitors a leg up, but it's impossible for me to believe that there cannot be a process that is established that ensures the privacy of the underwriting process, but at the same time exposes enough of it so that it can be evaluated by an objective analysis. So let me look to any other further questions or comments by our commissioners. So
Could
go
I
ahead.
just respond to that?
Absolutely.
I mean, that's really, in thinking about my remarks today, that's what I hope to encourage you to think about, is that that the state can create a much more transparent way in which the resilience actions are valued and recorded. Right now, as an example, the retrofit work that I do on my house for earthquakes, I got a building permit for. That's recorded in a building department. It's not on my assessor's record or any other sort of easily accessible database. And the same is true for all the other kinds of resilience work that individuals are doing. The program Wildfire Prepared that IBHS set up is really trying to make it sort of that you self-certify, or a FireWise community, that you can sort of self-certify and undertake a number of activities that then can be evaluated, and you can get a certification that these have been completed, and you can use that in as a negotiation. But I think creating the environment in which resilience is valued requires state leadership, and it is a data exercise, but it's also a huge coordination and collaboration exercise as well. And I also just would leave you with one other data point, which is it is a public program, and it has its faults, but the National Flood Insurance Program has something called the Community Rating System. And so there are many communities, you have to adopt certain regulations. The community has to elect to be in the National Flood Insurance Program for homeowners in that community to have access to the program. But then the community rating system is one step higher, where it actually communities who work their way through the rating system get evaluated by the types of mitigation actions they adopt, get different levels of mitigation discounts. So California has 528 participating communities in the National Flood Insurance Program, and 97 of those are community rating system participants. But it's generating, apparently, according to the Department of Water Resources, as another recommendation of maybe somebody you talk to, the people who run this program, because they send out and evaluate these communities and provide that sort of certification. Their actions are generating 10 million in premium discounts for the 100,000 policyholders in those communities.
Mm-hmm.
So that's the kind of, sort of government working to create the checks and balances necessary to not only encourage, the industry to value mitigation, but to also, be so transparent as to force it. So I just hoped you wouldn't. I think what the department's regulations are doing right now, in my opinion, is sort of leaving it to the insurers, leaving it behind a cloak, a curtain for the insurers and their vendors to kind of handle. And I think that as many people testified at the hearing that the insurance commissioner had this week, that's a missed opportunity. It's a missed opportunity for the state, for everybody else who's investing in resilience, to really know, are we moving the dial? Maybe we're not, I don't know. But it would really be great if we worked together and found some way that we could actually measure it and track it, and everyone would know.
Well, I think it's very helpful. What we've gathered from the three witnesses so far is going to be very, very helpful to commission staff and to commissioners as we frame our recommendations. And the fact that with respect to the flooding, that there's a model that we can turn to and examine and figure out, how to make it functional for California, I think is going to go a long way. And I'm looking at our list. We've got 87 participants that are watching this hearing. And I've got to believe a number of them are staff members of legislators that are across the street. And so you're hearing in its raw form some of the suggestions that have been made by people who are very, very experienced and very invested in finding solutions. And part of what I think we're all going to regret is the approach taken by the Department of Insurance is half a glass full, when there is an opportunity, and there should be an opportunity. And I was really struck by remarks by Representative John Garamendi when he spoke of missed opportunities, the way that things could have been done, and the authority of the office to help have a very coherent conversation about what homeowners in California are confronted with. The notion that there are people, for example, Dion Aroner, who's been doing business with a carrier for over 60 years, who now finds herself having to, maybe the next witness is going to be your best friend because it's the surplus lines. But I'm just going to, it seems to me that there has been an extraordinary level of neglect in addressing the kinds of things that California homeowners expect their government to be able to assist and provide. And so with that, it's a good thing I'm not running for office anywhere ever again. So Ms. Johnson, I want to thank you for what you brought to us today. Much appreciated.
Thank you. It's an honor to be here. Thank you.
Ms. Hurley?
Good luck with your work.
Thank you.
Thank you, Chair Nava. Our final witness today is Benjamin McKay. Mr. McKay serves as the CEO and Executive Director of the Surplus Line Association of California. Previously, he served as Senior Vice President for Federal Government Relations for the Property Casualty Insurers Association of America and as Chief of Staff to a member of the U.S. Congress. Mr. McKay, you may begin your testimony when you are ready.
Thank you very much. Good morning. My name is Benjamin McKay. I'm the CEO and Executive Director of the Surplus Line Association of California. I appreciate being invited here to discuss this very important topic. Today, I'm going to focus my testimony in 3 areas very briefly, because I can't wait to get to the questions. I feel like I could have just answered the last 3 sets of questions and had something to add. So I'll try to keep my comments brief and really just create an architecture that lets you know where I'm coming from and where the surplus lines industry fits into this rubric that is insurance. So let me start there. We're a 501c6 nonprofit association. We do a couple of activities on behalf of the state, one being reviewing for legal sufficiency every surplus lines policy. So there's about 1 million last year. We review them all to make sure they meet the legal requirements. Now that's critical, because if we're going to create a legal construct, it has to be followed if we think that legal construct is going to result in a properly functioning insurance market. And ultimately, some of those people across the street that Chair Nava discussed, that's what they're doing. They're trying to create a legal construct that hopefully, if followed, leads to the result we're looking for, which is more homeowners being covered, more affordability, and more availability, which of course are the 2 buzzwords of the insurance world. And I can dive into that if necessary. It's important to note that we represent the surplus lines brokers. So if you're looking at the food chain that is insurance, you start with a retail agent, who is the person the insured typically knows. And if that retail agent cannot place that homeowner's policy, for instance, their carrier pulled out of the state or isn't expanding writing, recently we saw Tokyo Marine, we saw State Farm before them. So if you're an agent of one of those, you have to find coverage somewhere else. So Commissioner Aaron, or this might be your situation where that retail agent has to go to a surplus lines broker. That surplus lines broker is going to have access to markets. We call them markets, but most people call them carriers, insurance companies, than this retail agent does. So the broker might reach out to Lloyd's of London. They might reach out to Munich Re. They might reach out to companies that you've never heard of, like Lexington and Scottsdale. Then they will either get one company to say, yes, we will insure this risk, or multiple. Sometimes the risk is very large and they have to get multiple insurers to agree to cover the risk. And then they contact the retail agent, who then contacts the insured and says, do you want this policy for this price? Yes. Okay, it's bound. And now you're covered. No. Okay, go back to the broker and they have to find another policy. That's the food chain, and that matters for this reason. The way California law is written, you first have to go to an admitted carrier. So that means a carrier licensed by the state of California. It's all the ones you see commercials about, Liberty Mutual and Geico and Progressive and Farmers and all of those carriers. They're your admitted carriers. And only if you go to 3 of those carriers and they say, no, we won't write that home for whatever reason. We don't like where it's located. The roof is made of paper. There isn't a fire hydrant within 60 miles. For whatever reason, if they won't write it, then you get 3 companies, they call them 3 declinations. You can then go to the surplus lines marketplace, which means you can contact a broker and the broker then reaches out to Lexington, Scottsdale, Lloyd's of London. If the surplus lines broker can't get the policy placed, then it should go to the FAIR plan. That's how the statute reads. Is that what happens in reality? No. There's a reason that there are about 60,000 homeowners policies in the surplus lines marketplace and 400,000 in the FAIR plan. And it's not because they went to surplus lines before they went to the FAIR plan. It's because they went directly to the FAIR plan in many cases. Either the constituent, your constituents just calling up the 800 number to the FAIR plan, or the personal lines retail agent who doesn't know about the surplus lines. It's not a well-known part of the market, particularly related to personal lines. On the commercial side, it's certainly more known. And that's really where the vast majority of surplus lines business is on the surplus lines, is on the commercial side. So what are what is the big issue with the FAIR plan? Well, and I think they've testified earlier, it's rate adequacy tends to be an issue, because if you can get a rate cheaper in the FAIR plan than you can in another market, you're going to go there. The second factor with the FAIR plan is if you're an admitted carrier, you're on the hook for any deficiencies of the FAIR plan, financial deficiencies. So if you're an admitted carrier, you're on the hook for your own risk, and then you're on the hook for your pro rata share of the FAIR plan risk. And as we all know, the FAIR plan, there's a concentration of bad risks in the FAIR plan, right? It's adverse selection. Only the people who couldn't get coverage end up in the FAIR plan. So all the risks, theoretically, I don't think this is absolutely true, but a lot of the risks, a majority are not what we call good risks. So you're covering, as an admitted carrier, your own risk plus that risk. And that's kind of unknown to you, because you don't have huge, we've mentioned transparency, visibility, a lot of visibility into that. So what does that mean for surplus lines? Well, every policy we can take out of the FAIR plan helps in a lot of ways. Number one, it gives people a carrier with whom to talk. The FAIR plan right now, as you've probably heard testimony, get 2,200 phone calls a day. I've spoken anecdotally to people who have those policies, and they just pray that they never have to call up with a claim, because they know that's going to be a very laborious, very laborious process and very frustrating process. They'd rather deal with an agent and a carrier. So that helps. It also helps because it reduces the risk of the admitted carrier, right? Now they don't have less of that secondary risk. And thirdly, it helps with the state, because then if the FAIR plan gets to be a manageable size, its customer service can improve. Perhaps what its offerings can improve as well. So Lastly, let me leave you with this. There was a lot of discussion in the previous panels about, what would you do? And how would you view this? And I would say one thing that has not come up, and I think there is, for obvious reasons that I'll state are obvious, there's a lot of focus on the admitted carriers. And the reason for that is, I think, is because the insurance department has full power and jurisdiction over the admitted carriers. They are domiciled here in California. They are licensed here in California. We do market conduct exams to make sure they're solvent, etc. So they become the focal point because we have the most, as a state, power over them. However, they are really just one part of the insurance ecosystem. The part of the ecosystem that really drives rates is the reinsurance market. And the reinsurance market is not in California. In a lot of cases, it's not even in the United States. And the reinsurance market is what lets these carriers lay off risk that helps them stay solvent. So if if you have agents, they want to place this whole community with you, but that's a densification. That's a concentration of risk that's too great. It doesn't make sense. Whether you have a model or not, just common sense says, boy, that's not a spread of risk. That's like putting all your money in one stock, right? You're probably not going to do it. So you spread the risk by going to reinsurance. Now, where does reinsurance money come from? And by the way, if this is too elementary, I apologize. I always start at the beginning. I usually start with the earth cooled, dinosaurs came, then insurance was created. So it helps me kind of, with my thought process. The reinsurance money comes from all the places you might expect: hedge funds, pension funds, private equity, all of this money that's fungible and travels in a millisecond across the globe to invest in whatever happens to give the best return given the risk. And so that reinsurance is what ultimately is going to these admitted carriers, who we put a lot of pressure on, and rightfully so. I mean, they are certainly the face of the industry. And just reacting to two things in advance, and these probably would come up in the questioning, but in case they don't, I'll lead off with them. Number one, well, actually just one. Commissioner Eriner asked about the rates and the National Association, California versus Florida versus the National Association of Insurance Commissioners, the NAIC, actually publishes statistics on this. So this is independent association made up of all the insurance commissioners from across the country. They get all the rate filings. They have all the data. In January 15th of this year, 2024, in the NAIC Property Insurance Report, they put out that California's average premium is $1,403 per policy. Florida is $2,437, so more than $1,000 per policy more, almost an increase of 100%. Louisiana is $2,259, and Oklahoma is $2,155. And I use those because the risk profile in those states is somewhat similar to California. So you can see that rate adequacy, at least, on its face, all things being equal, and I understand there's lots of factors that go into rates. It does seem like there's a gap there between us and some of the other states that are similarly situated. What does that mean? Well, just to give a sense of magnitude, and then I'll conclude. If you have a $500,000 house, which is considered a mid-market house in California, incredibly, and you pay $1,403 a year, you would need to pay that premium for 356 years in order for you to have paid enough premium to buy you a new house. That's just an example of why spread of risk matters, right? You've got to have a lot of houses that don't burn down or fall down or anything in order to make up for that 356 years of premium. So with that, I'm stand ready to answer questions. I thank the commissioner. Thank you, Chairman Navo. Excellent staff, by the way. Much appreciate them. I'm ready to ask questions, answer questions.
Thank you. Let me look my Vice Chair Cannella has been kind of quiet, but I was watching him during your presentation and he seemed to really enjoy parts of it. So I'm going to put him on the spot because I know you've got something going on there. and then I'll go to Commissioner Byer, and then Commissioner Garcetti.
I just appreciated his testimony, thought it was funny, some of the comments, so 60-mile fire hydrant, roof's made of paper, so I appreciate that. So.
Commissioner Byer and then Commissioner Garcetti.
Sure. I want to take you back to dinosaurs. So in thinking about insurance, one of the ultimate questions is who reviews the rates and how long does it take for that review to take place and how much is known about that process? That's pretty straightforward, pretty elementary, applies in every state. Is it not true that California takes longer and is more opaque than other states' insurance rate reviews?
It's my understanding that that is correct. I will also add to that that some states are use and file. In other words, you actually start issuing the rate, then you file. And then the commissioner comes back and says, yeah, that was a good rate. No, that was a bad rate. So having an intervener process, the whole Prop 103 process is unique to California and does take longer typically.
Okay. I want to focus on second on the reinsurance market. I'll call it the Warren Buffett market. I believe he's in reinsurance, right?
Yes, sir.
He's a pretty smart investor.
Yes,
so the reinsurers make money.
Oh, yes.
And they are not regulated.
Correct.
So are we, by adopting a proposal like the California Insurance Commissioner, permitting property insurers to use reinsurance and use that as a basis for adjusting their rates, buying a pig in the poke? In other words, that is, there's no control over the reinsurance market and its rates. And if you permit people to offset their risk by buying more and more reinsurance, won't rates go up disproportionately and the insurance commission can do nothing about it?
Yeah, that's a great question, and it's a really complex issue. I would say you're correct. The rates aren't regulated for a reinsurance company. However, every insurance company, I think, on the planet uses reinsurance. So it's sort of a reality of the system, including Florida, Oklahoma, and Louisiana.
Right, but you're kind of ducking the question, which is clever on your part. But so, is there a way to cabin or put limitations on the costs associated with the reinsurance?
Yeah.
In other words, I think many of us are sympathetic with what the insurance commissioner is seeking to do, which is, in a big picture way, have more insurers in California, have some rate competition, not have people abandoning homeowners, all that kind of stuff. And in order to get there, having some kind of forward model, having a permission to do reinsurance, all that's fine. But if rates double or triple, and we get to the level of Florida, what's wrong with that? Well, there are going to be a lot of homeowners who are not going to be able to afford it, and there's some knock-on effects. How do we prevent that kind of perceived, I'm not saying it is, gouging based on the black box of reinsurance?
Again, and I don't have a perfect answer. The real answer, the short answer is we can't, because we have no legal jurisdiction over them. So there's not much we can do except try and introduce other competition and other options into the marketplace. An example would be, we have a FAIR plan that has 400,000 policies that are, most people would say, including the FAIR plan themselves, aren't at actuarially sound rates. But to your point, if you went from where they are now to actually sound rates, the consumers would be harmed in a significant way. It's too much. Why? Because we've had rate suppression for a while. So that means that if you're not incrementally increasing, you're keeping it down. All of a sudden, when you do increase, instead of this incremental, you got to go big. So what can you do as a state? Some of the things I've seen other states do is when they'll have a takeout plan where they'll say, okay, FAIR plan, we're going to let private carriers take out policies, and for each and sometimes they say it's got to be this many in this zip code, this many in that zip code. and they'll say, we'll subsidize that to account for that actuarial differential. But to get that $200 per policy, you have to stay on that risk for some period of time. So a year or 2 years, whatever it is. And that's obviously a sliding scale. So I think you have to create these intermediate programs that get you to an actuarially sound rate. Because I completely agree. If you just say, okay, we're just going to let the free market reign today, take all the controls off, it's going to be, you're going to create an untenable situation.
So next point, one of the provisions in the insurance commissioner's plan, if I understand it correctly, essentially says, if you're an admitted plan and you want this kind of relief, you're going to have to offer insurance a certain percentage of your book of business in what I'll call distressed neighborhoods.
Yeah.
Either high flood, earthquake, or economically distressed.
Yeah.
And that seems like a good idea at a superficial level. How would that get implemented? And isn't that going to be the subject of a lot of gamesmanship in order to cherry pick neighborhoods based on misleading data? That is, calling Beverly Hills distressed doesn't make it distressed.
Yeah. Yeah. Well, I mean, data integrity is essential to any good public policy that's based on data. No question about it. And we need to spend a lot of time on data integrity, period. Secondarily, yes, you're right. Everybody, if I'm a policymaker, if I'm an elected official rather, I'm going to want to be a distressed area because I'm going to want my constituents to benefit from this program. So I think politics enter at that point. So I think you're absolutely right. Have I seen it work in other places? I have. They go by zip codes. We see it even.
Let me interrupt there.
Yeah.
So in the administration of the previous president, Congress passed and the president signed into law an economic innovation zone thing that was based on zip codes.
Yeah.
And the research that I've seen suggests that a substantial portion of that ended up providing tax breaks for construction of college dormitories.
Yeah, yeah.
Because the income level of schools is lower because students are not working full time. So that was a well-intentioned bipartisan effort that ended up being, frankly, in part, a ripoff.
Yep.
So what would prevent that kind of zip code gamesmanship in the insurance sector?
Yeah, well, you just have to have good public policies and good people implementing. I mean, accounting shenanigans. I took accounting 30 years ago, and they made us read a book called Shenanigans, and accounting shenanigans have been going on ever since. We've been trying to solve the accounting shenanigans problem since there's been dual entry accounting. It's not impossible. There are public policies that do hit the mark. I think it's one of the important roles of government is to, as this commission does, right, agonize over these issues in order to try and ferret out these bad deals or these side deals that go against the heart or the spirit of the public policy. They don't all work, but a lot of times they do. I know, for instance, in our industry, years ago there was a lot of pushback on redlining. I don't know if you recall where they would redline. We're not going to write anything in this area because it's a distressed, what we would call now a distressed area. You don't hear very much about that anymore. And the public policy was, well, in most states, we're not going to even let you know what the demographics of the people who live in this area are, and your model has to be blind to that. And it largely solved that issue. So issues do get solved, but I agree with you. There's no end to the ingenuity of scoundrels.
Well, the redlining problem was also addressed by the Community Reinvestment Act.
Yes, it was.
Which some people have wanted to deregulate, and banks are not really big fans of. But in this case, for homeowners insurance, the set aside the insurance commissioner has proposed seems toothless.
Yeah. Yeah, I mean, I can't evaluate, we haven't evaluated that independently, but I absolutely agree with you on the Community Reinvestment Act for sure.
Commissioner Garcetti, please. You're muted. Gil, you're muted. You're muted, Gil.
I'm sorry, my fault. Mr. McKay, thank you very much for being with us for 2 hours, plus the time it took for you to prepare for this. Very much appreciate it. My questions are not going to be as challenging as Mr. Bryo's. Mine is more points of information, if you would, please. Do I understand it correctly that if a homeowner loses their insurance, they could go directly to FAIR? They don't have to go to surplus. Is that correct?
I'm saying as a practical matter, they do, but under California law, they're not supposed to.
So are you saying that FAIR does not enforce that? Does FAIR not, I don't know if you can answer this question, does FAIR not say, all right, did you go first?
My understanding is they don't. I also, my understanding, well, my belief is there's no enforcement mechanism in statute. It just says, here's the order. There is an enforcement mechanism from going from an admitted carrier to a surplus lines carrier. There's entire sections of the statute that talk about, you know, you have to go admitted first, then you can go surplus lines. But there's only one section that says go admitted, then surplus lines, and only then do you go to the insurer of last resort, who should be last in that food chain.
All right, that's helpful to know that I'm doing it. Second question, my last question is, let's assume that they come to you, you're finally able to find an insurer, a company no one has ever heard of. Does that company have to be, quote, admitted or licensed, the two or one, before you can say, okay, sign them up?
They do not have to be licensed in California, but they do have to be licensed somewhere. So they could be licensed in Nevada or New Jersey or any other state. And then they can write, if they have enough capital in surplus, which is 45 million, compared with an admitted carrier who only needs about 5, then they can insure California risks.
Okay, but this is only then US companies. It cannot be a foreign company.
It can be a foreign company, a country, yes, foreign company, yes. We call, I mean, it's terrible vernacular, but companies outside of California are called foreign, and companies outside of the United States are called alien. Which you never really want to tell your insured that you're sending their policy to be insured by an alien.
Okay.
Yeah.
And can you give us an idea of the percentage of cases of insurance policies that you are able to place that are, quote, from alien companies?
Oof, that's an excellent question. I don't have that breakdown, but I can get it to the commission after the meeting.
Thank you. Appreciate it.
Yes.
Thank you.
Thank you.
Commissioner Aaroner.
Yes, thank you, Mr. McKay. This has really been helpful. So I think you know I'm in this predicament. So when you mentioned this idea that before one can go to the surplus lines, that they have to be able to show that they have been turned down by 3 companies, right, currently serving. How would I have known that until I heard your testimony today?
You probably wouldn't as the insured, but your retail agent who is licensed and trained should know. And then that licensed retail agent should inform you that they have taken your policy to, let's pick 3, Liberty Mutual, Allstate, and State Farm, and they've all been declined. Therefore, we're now going to try and take you to the surplus lines market. And that's notable. And I, in full disclosure, it's notable because the surplus lines market is not subject to the guarantee fund. So they really need to inform you. And on your policy, it'll say in really big type, you know, that this policy is placed, you know, in surplus lines and not backed by the guarantee fund. So if your agent isn't, you know, showing, you know, if you don't see that, that's a problem. Okay.
And then second of all, this issue regarding reinsurance. So I carry an umbrella policy. Is an umbrella policy reinsurance? Because that's how I consider it.
It's a policy just like your homeowner's policy. It's an excess policy, and And it can be a surplus lines policy, but it can also be an admitted policy. You know, some people call them wraps, some people call them excess. For homeowners, they're called umbrellas because it covers like an umbrella, everything in your homeowners. But if you told me the carrier, I could tell you whether it was admitted or surplus.
So it's been, so that my carrier right now is AAA, and then I have an umbrella, right, which is not expensive and gets me, I can't remember, up to $4 million or something.
Yeah.
Right. And I've always presumed it was like Lloyd's of London who that was, or I guess now you're saying it could be Berkshire Hathaway.
Could be.
Or somebody else.
Absolutely. Yeah.
But
Absolutely.
it could just be another insurance company?
Could be. Yeah, absolutely.
Oh, okay, great. Thank you so much.
Yeah, absolutely. And, you know, and in terms of, you know, not being part of the guarantee fund, but making sure that carriers have the solvency to pay claims. You know, I mentioned briefly that the capital requirements for a surplus lines carrier are much greater, 9 times greater than that of an admitted carrier. And if you're talking about Lloyd's of London and alien insureds, they have to put money in a trust fund that is located here in the United States that has sufficient funds to cover claims. So you're protected that way by alien insurers. And plus with Lloyd's, they have what's called the central fund, which is a multi-billion-dollar fund that will pay claims if one of their, they call them syndicates, but one of their companies can't pay.
Okay. And then if I understood you correctly in your opening remarks, your association does some review of the members, right?
Correct.
Right. And so you do some, right, to be sure that everybody's meeting your standards, obviously, not necessarily a state standard, but they're meeting a standard for your association, correct?
Correct. There's 2 standards. One was created by the Dodd-Frank Act back in 2010. You'll probably remember that. There was Title V was called the Non-Admitted and Reinsurance Reform Act. And in that they federalized, which is unique for insurance because your insurance has been a state regulated industry for 100 years, with the exception of 1 year, 1944. Whereas, you know, banking, financial services, you know, securities, that's all federally regulated. However, in the Dodd-Frank Act, they created a minimum standard for surplus lines carriers, which was you have to be licensed somewhere and you have to have at least 15 million in capital or surplus, but the states can make that 15 million greater. And California chose to make it greater. We made it 45 million. So that's the threshold. Now we have what's called the list of approved surplus lines insurers. Well, not we do, the Department of Insurance does, but we make recommendations on who should be on it or removed from it. And that list is a much more rigorous review. It's a full-on solvency review of your finances. How do you keep your money? You know, is it in olive oil futures or is it in gold in a safe? You know, how is that money maintained, and how are you part of this legal entity? Because it's very rare that you have just one legal entity, right? It's usually you're part of a conglomerate, and what are the legal rights between the various parts of that conglomerate, and which becomes very tricky, particularly if one of those legal entities is a bank, because of all the banking regulation, source of strength rule, which means the bank is predominant in any organization it's a part of. So we do that review. If you pass that review, we recommend that you get put on the list of approved surplus lines insurers. And that's like the good housekeeping seal of approval for insurance companies for surplus lines.
Thank you so much.
You're welcome.
Okay.
Yes, thank you, Mr. McKay. There's been some discussion. I want to talk a little bit about the surplus line carriers. So we know, for example, with the folks that are over at the fair, being covered by the fair plan, that there's been a reference that it's limited. That so, for example, contents are not covered. So if you have a tragedy, you're going to lose your furniture, you're going to lose your clothing, you're going to lose your valuables, all the rest of that stuff. As it relates to surplus lines, can surplus lines provide the same level of coverage as an admitted carrier?
They can, yes.
Okay.
And on the commercial side, notably just today, Munich Re Specialty sent out a press release saying they're going to write a commercial wrap. So what that means is For the commercial clients of the FAIR plan, any coverage that they're lacking that, from a comparable admitted policy, there's a wrap they can buy that'll pick up and provide that coverage. So what I would hope is that happens in the homeowners market as well. And it just, some of the answers to your questions are market innovation. And here's one that just happened today.
Right.
Hopefully that we get some of that in the homeowner side as well. But yes, that we can.
Well, it seems to me what Commissioner Garcetti raised is an important issue, and that is who has the responsibility to inform the homeowner when they have lost their coverage that there is such a thing as surplus lines, and if instead those 400,000 people that are over at the FAIR plan had been told by the FAIR plan, have you looked at surplus lines, right, before you knocked on our door, that homeowner might be in a better position. They might be able to get coverage that includes content. I don't know what the premiums would be, but I suppose the point is that the homeowner isn't aware of, I never knew about surplus lines until we started talking about them through this commission, and that the surplus lines might provide, the kind of relief for that homeowner that would make their transition, once having lost their initial policy, a little less painful.
Yes.
So I thank you, Commissioner Garcetti, for raising the issue of, disclosure. So looking at other commissioners, I see no hands being raised further. Mr. McKay, this has been very, very illuminating. And I appreciate you taking the time to share your expertise with us, so that as we discuss our recommendations with staff and with others, that we have a better understanding of surplus lines.
My pleasure. It's an honor to be here. Thank you.
Thank you, sir. Now, Ethan, I suppose we're looking at the public comment time, right?
We are, Mr. Chairman. We've completed the witness portion of the agenda, so we can move to public comment. For people who have joined the meeting via Zoom, please use the raised hand function to indicate you wish to make public comment. If you have phoned into the meeting, please email us at littlehoover@lhc.ca.gov. That is littlehoover@lhc.ca.gov. Those instructions are on the screen. Email us immediately and give us your phone number so we know who to unmute. But if you've joined by Zoom, please just use the raised hand function. That's much better. In keeping with the Commission's longstanding practice, public comment is limited to 3 minutes per commenter, and the Commissioners will be able to hear you but not see you while you make public comment. We will begin with public comment in the room here at our location, and there is one person who wishes to make public comment, Stacy Heaton of the Rural County Representatives of California, who has testified before the Commission previously and is here now to make public comment. Ms. Heaton.
Thank you so much. Good afternoon, and just a refresher, RCRC represents 40 rural counties statewide, and a lot of our member counties have suffered a lot of the very high severity wildfires that have happened in the last 10 years. And so we have a lot of residents in our communities that are suffering from the non-renewals, from difficulties finding insurance policies, from having to go on the FAIR plan. So we're hearing about this a lot. Our board is made up of an elected county supervisor from each of our member counties, so they're not insurance experts. They don't know a lot about the complexity of the issue, but we've tried to educate them and help them to understand a little bit more about this, since they hear about this so much from their residents. So we understand that this is a very complex issue. Our communities are doing amazing work on community resilience and community hardening. They're leveraging federal funds and state funds, including the state's California Wildfire Mitigation Program, to help individual residents harden their homes. But property owners are struggling. They're struggling with affording homeowners insurance. I talked to someone that lives in one of our communities just a few weeks ago who is considering selling his home because his insurance went from $1,500 a year to $8,000 a year on the FAIR plan. And he just doesn't know if his mortgage cost with that on top of it is worth him staying in California and paying that long term. We have folks that recently in one of our counties, a low-income development project had to be abandoned because they could not get it insured. And by state law, our counties are required to do low-income development. And it's that struggle between developing in high wildfire areas and meeting their regional housing needs assessment requirements for the state. We've tried to pass legislation in the past that would allow them to move those units elsewhere in lower fire risk areas in their counties, and that legislation was unsuccessful. So we are very engaged with the Department of Insurance on the sustainable insurance strategy. We intend to keep being engaged with our communities and our counties and on the SIS as it moves forward. And we intend to continue being engaged with the Little Hoover Commission as this study moves forward, and we appreciate this work. Thank you.
Thank you very much. We'll now move to, we have no other people in the room wishing to make public comments, so we'll move to people wishing to make public comment online. Shara, if you can identify the first person online.
Yes, we have Christy R. Christy R., you now have the ability to unmute yourself.
Okay. Hi, my name is Christy Reisman, and I'm a mortgage broker in Calaveras County, serving primarily Amador, Calaveras, and Tuolumne counties. So 90 to 95% of my closings all are using the California Fair Plan right now. So professionally, I'm really familiar with this process. I also have California Fair Plan personally on one of my properties, so I've dealt with them in that format as well. I was really pleased to hear Commissioner Nava say that to mention possibly subpoenaing the insurance commissioner. I'm really disappointed that he is not here involved, or a rep from his office isn't here involved in this conversation. I'm really grateful for the California Fair Plan, because without it, most residents in the foothills from Redding down to the southern desert would not be able to get a home because they wouldn't be able to get insurance. And it seems to me, I've thought this for years, that the solution to this massive problem would be for the insurance commissioner to remove the Prop 103 premium limits for listed companies in the high fire areas, so that companies like State Farm, Liberty Mutual, Allstate, AAA could come back into the foothill areas where they've stopped insuring over the last couple years. And they might have higher premiums, but at least it would give people a choice. And as was alluded to and put in an answer to a question earlier, the California Fair Plan is just strictly fire, no content. So you have to get a second policy called a difference in conditions, or DIC policy, which just makes it even more expensive. Whereas if some of these listed companies could come back into the market, it would be comprehensive insurance. I wanted to address specifically about the California Fair Plan. One of the issues that I've run into a lot with it recently, and they did just upgrade their system. So all the statements that I'm making are in reference to the newer system, not the old one. And their quoting system, their quote generator, is wildly inaccurate. I've had many clients over the last couple months who will get a quote initially right when they're making an offer on a property to buy. And one example is a quote came back saying that the premium was going to be $1,198 for a $5,000 deductible. After underwriting, the premium went to $3,876 with a $20,000 deductible. So it would seem like the California Fair Plan could do something to strengthen the quality of their quotes. This does not happen with the difference in conditions policies. So I know that the data is out there to get information. And thank you very much.
Your 3 minutes have expired. If you can wrap up quickly, please.
Okay.
Thank
All
you.
right. Anyway, it would be nice if they could firm up their quotes. And then I thank you for doing this forum. It's very, very important.
Thank you. Sheriff, we can go to the next public commenter.
Okay, next we're going to have Carl Sussman. You now have the ability to unmute yourself.
Wow, it's just like I would do with my wife. I now have permission to speak. Thank you so much. I appreciate the opportunity to talk today. Thank you to the commissioners for having this forum. I'm in a 30-year insurance broker, an insurance expert witness in state, federal, and criminal court, and as well as I talk on the radio throughout California on the largest syndicated talk radio program about residential insurance for clients. So this is sort of my thing. And one thing that I'm finding is that there's one piece of this puzzle that everyone seems to be missing, and that's the education factor. And I have to just say this, and I mean it without any disrespect. Everyone keeps saying, I've heard it 2 or 3 times during this hearing, that FAIR Plan does not cover contents. That's simply untrue. Personal property absolutely is covered with the California FAIR Plan. It's a line item. It's even covered at replacement cost. So I don't know where that comes from, but it's just a matter of the information's inaccurate. So what I'm hoping for, and when I'm here to sort of talk and hope that we can put in the report or to strongly suggest, is that we focus on a way to try and educate consumers so they really understand what it is they're getting, what it is they're supposed to be getting, and how to get the best possible options available. We need to educate them on why their rates go up. We certainly need to be able to educate them on surplus lines, as it was discussed. We need to educate them on an agent versus a broker, specifically these days on how State Farm has agents. So when they're getting non-renewed, they're not allowed contractually to shop for another policy. We have to educate them on how to save money on hardening their home, even how to save money with defensive driving courses. Just in general, how insurance works, how claims can impact their policy, how the concept of no loss is better than a covered loss. I hear that all the time. Most people are more interested in getting their loss covered than preventing the loss altogether. And that's something that as a society, as a community, we really need to make a change for. And we can do that with education. We need to be able to educate people on where to go, where to get help, and where the resources are. And most importantly, that people need to be more proactive with their insurance products and what they do, because with these new guidelines that are coming out, like them or hate them, it is going to put the onus a lot more on the clients to be able to do things to lower their premium. They will be able to have their next door neighbor paying significantly more or less money, depending on what they decide to do to affect those rates. So my hope is that we can somehow find a way. I heard someone mention something about a czar, and I think that's more about legislation and communication between departments. That's obviously critical. But if there could be someone, some position, some central repository where people can get educated on these things, I think that now more than ever, because insurance is not the way it was. What's the expression? This is not your grandfather's insurance. I mean, things are really different. Things are going to be different going forward. And so educating the public more is more important now than it ever has been. And I use the example again just today with what we're talking about, personal property on the FAIR Plan. So if there's any questions, I'm happy to take them. Otherwise, that's my comment for today.
Thank you very much, sir. Your 3 minutes has expired. Thank you.
Okay, our next comment will come from Kate Gordon. You now have the ability to unmute yourself.
Thanks so much. Kate Gordon, former director of the Office of Planning and Research in the Governor's Office, and I ran a catastrophic wildfire commission that Chair Nava was on. So thank you again for that service. Also, author and founder of a report which Hank Paulson, former Treasury Secretary, Mike Bloomberg, and Tom Steyer and I put together on the economic impacts of climate on specific industries and regions. And so very familiar with these issues. I have 3 quick points I wanted to make, and thank you so much for having the hearing. The first is following from Laurie Johnson's testimony. This question about silos is really important and critical. There is, in fact, already a part of the governor's office that is supposed to, by statute, coordinate across agencies. It also includes the current Office of Adaptation and Resilience. That's the Office of Planning and Research, which I used to run. So that office actually does have the responsibility to coordinate across agencies and runs FAICP, which runs the California Climate Assessment, which has the potential to provide data that is consistent and coordinated and open source for these agencies. So I think the issue with OPR and FAICP has primarily been a resources issue, but the structure already exists. Those agencies are there. FAICP is there. The California Climate Assessment is in existence. So just would encourage the commission to look at that. The second and related point is actually having run OPR and then going into the Biden administration, into the Department of Energy as a senior advisor for the last 2 years. I am now convinced actually that the planning and resilience functions of the state need to be elevated to a state agency with a legislatively confirmed secretary. There's a good report from Sarah Karlinski at Spur on this point, making an argument for a planning agency. I think that given the interrelated issues we're facing with increased climate impacts and those effects on housing and transportation infrastructure, as well as on insurance and utility rates, having an agency that is resourced, that has a confirmed secretary, really with the intention of looking at long-term planning for the state is critical. So just that would be a Hoover Commission function. So wanted to put that in front of you. And then finally, to Mark Ghilarducci's point, I was so honored to get to work with him about being proactive about prevention. I think we have to come up with a solution for existing homeowners, of which there are many in these areas, but we also really need to be proactive about new building policies and rebuilding policies. This is not the climate we have lived in for the past even 20 years ago. This is a increasing problem in severity, in frequency. We should not be building as if we are living in the California of yesterday. We are just creating new costs that are socialized across ratepayers, insurance payers, and frankly, also the state of California. We've tripled firefighting costs from 2015 onward. We cannot continue to spend this kind of public money on these issues when we know exactly how to prevent them. Thank you so much for the time.
Thank you, Ms. Gordon.
Thank you. Our next speaker will be Nevada County Supervisor Heidi Hall. You now have the ability to unmute yourself.
Thank you so much. Nevada County Supervisor for 2 terms up here in a rural county of about 100,000 people, 3 small towns. I really appreciate this hearing and the previous one, and I want to really, Mr. Ghilarducci said, and also Dr. Johnson, really love the idea of a statewide model and data set that everyone can use. Mostly, I really want to make sure that folks are understanding exactly what is happening on the ground outside of the theories and the assumptions. Where I live, this issue raised its head a couple of years ago when our fire agencies were being priced out of the insurance market, and one of them had to close for a short time. Then we started seeing homeowners rates double and triple. So yes, we have people who can't sell their homes and people who are dropping out of buying homes. Last year, we had a nonprofit center for the arts institution right downtown with a fire hydrant right in front of it, have their insurance rates double. Between double and triple. And just this year, we have what is very difficult to do in a rural area, build a low-income multifamily 48-unit building that in February was killed because the estimated insurance cost of about $41,000 actually came in at over $400,000. So we are required to be building low-income housing. We can't do it now because of insurance rates when we get everything else together. I want to emphasize, because I'm not hearing enough of this, that we are doing everything on the ground. Personally, my neighbors, we put in tens of thousands of dollars on our homes. We have almost 100 Firewise communities up here who've been in hundreds of hours, thousands of dollars at the neighborhood level. And the county itself has put in millions of dollars with the help of CAL FIRE to do fire breaks and mitigation along roads and evacuation route planning. We are doing everything we possibly can, and yet we are not seeing the discounts from the insurance companies. They are still leaving and they are still pricing us out. So my number one request is that we really lean on the insurance companies to recognize those of us and those communities and those governments who have been doing the risk reduction work for years now, and do something to help us with those rates. People on the ground are hurting. And I want to remind you also that many of us are surrounded by national forests, state parks, and Bureau of Land Management. It's often not our risk. It's the risk of the public lands that have been mismanaged for decades. We have great relationships with all of our agencies. We're working with them in partnership to clear and mitigate, but it's not enough. And again, the risk reduction is not being recognized. So thank you so much for the opportunity and look forward to your report. Would love to see some solutions laid out. Thank you again.
Thank you. Our next speaker will be Nancy Watkins. You now have the ability to unmute yourself.
Thank you for letting me speak today. Hi, I'm Nancy Watkins. I'm an actuary with Milliman in San Francisco, a specialist in catastrophic risk and property insurance availability and affordability. Just 3 comments today. First, the framework that Laurie Johnson outlined has also been endorsed and written up in detail by the CAL FIRE Risk Modeling Advisory Work Group, which was formed pursuant to AB 642. I served as a volunteer on that, along with people from CDI, CAL FIRE, lots of other stakeholders around the state. There was a draft in for 2023. As I understand it, still hasn't been issued yet, but it has a very good plan on community data, modeling, and mitigation. Second, this idea of a mitigation database is an extremely important one. It would form the backbone of any kind of insurance discounts that people want and any kind of effective mitigation planning. I've been working with Western Fire Chiefs Association, Cal Chiefs, Cal Poly, Colorado State, and IBHS on this. We've just finished up a pilot for IBHS where we created a sample data specification for a mitigation data, interviewed 5 of the top 10 insurers in California and 2 of the global reinsurers that are important for capacity. All of them have indicated that this kind of data commons would contribute to their understanding of community risk in the WUI and see benefit and participate in this. They also indicated that a lack of confidence in understanding wildfire risk is a key component of our insurance availability crisis right now. So I do think that we have a webinar that we just did it on Tuesday. It'll be available online probably in a week. If y'all are interested, you can email me. Third, to Kate Gordon's point on building, there is a possibility that new building outside of existing WUI communities would actually reduce the risk in those communities if it's planned properly, and if it is sufficiently resilient to disrupt fire pathways. So I do think of that as a win-win if we can start looking to that as a solution. Hope that's helpful, and I'm happy to help the commission in exploring these opportunities.
Thank you. Our next speaker will be Michael. Michael, you now have the ability to unmute yourself.
Hello, my name is Michael Taylor. I'm calling from Nevada County, and I recently ran for District 1 Supervisor, and I'm pleased to hear that Heidi Hall was listening to this and would like to echo some of her concerns. Can you hear me?
Yes, we can.
Okay. As a private citizen, I've recently experienced that my CAL FIRE, the California Fair Plan insurance has gone up 25%. And it was interesting to listen that the woman that spoke earlier about CAL FIRE, the California Fair Plan, said that they were approved to raise rates 15%. I'm concerned that there's not better oversight of the California Fair Plan in reference to what they are charging. I'm getting charged, I think, $4,000 for one of my properties. I think another $5,000 for another property annually, and it originally started off at like $1,500 or whatever. And then I was listening to the other person speaking about insurance, that he said that in California that the average is about $1,500 per household. In Nevada County, it's skyrocketing, and it's gone crazy with what our insurances are costing. And I guess I'm looking for or asking that there might be some sort of regulation in better oversight of the California Fair Plan. And I appreciate the opportunity to speak. Thank you.
Thank you. There are no more hands raised at this time.
Thank you very much. So, Mr. Chairman, I think we have completed the agenda for today. The next scheduled commission hearing is May the 23rd. That will be held in Silicon Valley, and will focus on AI in government, and we hope to secure a venue next week, and commissioners will receive information about travel plans shortly thereafter, so we'll be in touch on that. But I think, Mr. Chairman, we've completed the agenda for today.
Very good. Once again, let me express my appreciation to staff for putting the meeting together, and I think for putting together an extraordinary list of witnesses who really provided us with some in-depth information, a lot of which was really very new to me. Looking at the commissioners, I see no one wanting to make closing remarks or comments or statements. And Commissioner Aroner, I wish you the best in your search for resolving your particular issue. All right, everybody. Thanks again for a great meeting. Much appreciated. See you in about a month or so.